Hey everybody, it's Tortoise Investing coming at you today. We're going to be talking about SCHD, what makes it tick. We're going to be taking a look at the top 5 holdings by allocation percentage in SCHD through Qualtrim Insights. So if you are new, please hit that subscribe button, join me on this investing journey. Hit the like button and comment down below. Do you own any SCHD? Let's talk about it. Those things help the channel out a ton, and I greatly appreciate it. Now, without further ado, SCHD, the one of the most popular dividend ETFs out there. If we take a look here, we got Texas Instruments coming in at 4.44%, Amgen coming in at 4.32%, Lockheed Martin 4.21%, Chevron Corp 4.16%, and PepsiCo at 4.15%. Now those 5 make up 21.28% of the overall portfolio, and the top 10 make up 41.06%. So pretty heavily weighted in the top 10 holdings. It has a little bit over 100 total holdings, I believe. 103 total holdings. So with SCHD, if it's something that's been on your radar, it's something that you've been buying into and nibbling here and there, it's pretty much not gone really anywhere for like the past 3 years. So May 7th, 2021, we're setting at 77.41, and today we're setting at 79.16, up 2.26%. So over the course of 3 years, you could have been buying this here, just all the way through if you're doing a good little DCA method, and you know, sometimes that's the game plan. Not all stocks go up all the time. And, you know, this, a lot of people might look at that as a red flag, but you know what? It's been up 50.29% over the last 5 years. Yeah, it's been flat for the past 3, but during that time, you're getting dividends, you're getting to reinvest those and build your snowball up more and more and more. So I would look at this as an opportunity to build a share count. Now, take a look at the top 5 holdings inside SCHD. So if Texas Instrument Incorporated, they are mostly known for like the calculators, the TI calculators. Just free cash flow yield of 0.34%. That's not good. The cash flow has been an issue with them. They have, if I remember correctly, some expenses. Yes, their capex is $5 billion plus as of last year. Take a look here at the revenue. Revenue 3.68% over the last 10 years. Pretty stagnant. Free cash flow was trending in the right direction, but now not negative, but big decrease from last year. EPS 13.98% over the last 10 years, so that's good. Their balance sheet is something that they've always had a good hold on, and the dividend over the last 2 years grown at a rate of 6%, so a bit slower than usual. We'll take a look here at the quarterly. Yeah, so the debt is growing, but looks like the cash flow is growing in line as well. They have almost as much cash as they do debt, so it's not really too big of an issue there. They are buying back some shares, which I'd love to see. Let's take a look back here on the quarterly. It looks like they haven't bought any back in a little bit, though. But still, over the last 10 years at a rate of 1.93%, you want your companies buying back those shares. The return on capital employed usually been pretty solid. I know industry averages are around 9 to 10%, and this has been reliably above 20% for forever and a day. Again, they had that big drop off though last year. Next up, we got Amgen. Amgen just free cash flow yield of 3.89%, dividend yield 2.93%. Revenue's been growing at a rate of 4.2% over the last 5 years. Take a look at the free cash flow. Pretty flat, 2% growth over the last 10 years. EPS, 6% over the last 10 years. Again, last couple years here, it looks like it's been pretty stagnant. And the debt situation, we got $63 billion in debt. The EBITDA was $14 billion. Red flags for me personally. I don't like companies that have more than 3 times their EBITDA in debt. They are paying us down a little bit at $60 billion, but still, EBITDA of 14.8, 3 times is like 45, not even 45. So that tells me that, that's red flag. Something's going on for them to have that big a jump with their debt. I don't know if they had an acquisition or what. The dividend been increasing at a rate of 13% over the last 10 years. So it looks like here recently slower, just at 7, a little bit over 7% over the last 2 years. So the shares outstanding does look like something that they are doing, and they are continuously buying back shares. It looks like their final count was at 536 million shares outstanding. So they are buying those back pretty aggressively at a rate of 3.46% over the last 10 years. And the return on capital employed, again, has been pretty stagnant right there at the 10-11% area. Now, I know this is a bit of a rapid fire, trying to get through these. If you want me to do a deeper dive into anything, let me know down in the comments down below. I'd be more than happy to look into some stocks that you can recommend. Now, Lockheed Martin, just free cash flow yield of 5.27%, got dividend yield of 2.7%, payout ratio just below 45%. Revenue's been growing at a rate of 4% over the last 10 years. The last couple of years, though, pretty flat. Free cash flow, same situation, 5% over the last 10 years. Here recently, again, pretty flat in the free cash flow department. EPS, 11.68% over the last 10 years, so that's nice. They're growing the EPS, so probably buying back some shares. Debt as of last year was $16.43 billion. Their EBITDA was $10.44 billion, so not an issue there whatsoever. It does look like it had a small increase up to $19.25 billion, but again, that's not really too big of an issue. The dividend has been increasing at a rate of 9% over the last 10 years. Here recently, around 5 to 7% average is what they have been issuing, but still pretty nice mid-single digit, which is long-term inflationary beating growth. And shares outstanding, they've been buying back shares at a rate of 2.59% over the last 10 years. 251 million. Take a look here at the quarterly. 241, so they're buying back shares aggressively, which is nice. I'm hoping that this recent dip that they had back here, where they dipped, I think at one point, yeah, they were in the low 400s area, 420, 430s. I hope they were buying back those shares around there. And we take a look at the return on capital employed. It's been above 20% for a while now, ever since 2018, pretty reliably hovering around that 23-24% area. Next up, we have Chevron Corporation. It's a very popular one amongst people that like to own the oil industries. We got just free cash flow yield of 6.06%, a dividend yield of 4.01%, payout ratio just below 57%. Revenue, that's the thing that kills me with these energy stocks, these oil, gas, anything dealing with that type of thing, is it's very all over the place. And you're going to see this free cash flow. You got your up years, you got your down years. I personally stay away from these, but I know they're very popular. Over the last 5 years, 35%. Over the last 10 years, 32%. So, again, you have your opportunities to get in, but it's so up and down. It's all over the place, so volatile. It's the reason I personally stay away from them. Debt, $15 billion. That's not really an issue. EBITDA was nuts, $47 billion. Dividend's been increased over 5% over the last 10 years, and pretty reliably doing that, 5 to 7%. Looks like the last 2 years been over 7%. So they're increasing how much they give out with that dividend just a little bit, which is nice. Shares outstanding. This is, again, they issue some shares here and there, and then they buy back some, a little bit all over the place. And the return on capital employed, again, it's going to kind of be everywhere. Ups and downs and all around. It's just kind of the life of an oil energy company when it comes to holding individual stocks with them. And lastly, number 5, we got PepsiCo, just a dividend cash flow yield of 2.8%, dividend yield of 3.06%, payout ratio of 76%, so a little bit there on the high side, but that's a-okay. Revenue's been increased over at 3% over the last 10 years. Free cash flow, been pretty flat, honestly, rate of 1% growth over the last 10 years. again, they were making just as much as they are now back in 2015. So about 10 years ago, they were making right around this much free cash flow. EPS has been growing at a rate of 4% over the last 10 years, so a little bit slow and steady growth there. Debt's $37 billion, EBITDA 17 billion. Take a look at the quarterly, see if it's about the same. Yep. So not an issue, but still something to keep your eyes on, because with that payout ratio being what it is, you never really know. Dividends been increased already 9% over the last 10 years. This last 2 years have been averaging double-digit growth, which is very nice. And shares outstanding at a rate of 1.2% over the last 10 years, but here recently it looks like that has slowed down with the share buybacks. And the return on capital employed since 2020 dip, we are trending up into the right, in the right direction. So yep, there you go. The 5 holdings that make up SCHD, and let me know what you think down below. Let me know if there's any stocks or anything that you'd like for me to personally look into a little bit deeper, and if you own SCHD, let's talk about it. Thank you for watching. Hit that like and subscribe button for more, and until next time, take care. See you.